I want to bring in someone who knows an awful lot about the recovery, Jared Bernstein, member of President Biden's Council of Economic Advisors. Let's start right there, Jared. The economy looks very strong. Blowout retail numbers, jobs numbers yesterday. But how concerned are you about the threat of inflation? It's happening. Food prices, gas prices, real estate prices.
Well, I'm paid to worry about everything, and I must say I do a good job of that. We look at the inflation story, very importantly, trying to distinguish between heat and overheat. Much as Dom was just saying, we expect our policies, particularly those embedded in the American Rescue Plan right out of the gate, to help by producing and distributing the vaccine to pull forward this expansion so people can safely re-engage with commerce, at the same time providing households and businesses with the resources they need to re-engage with commerce. Now, we expect that to create some heat, and we're seeing that in the inflation statistics. But there's a big difference between getting closer to the kinds of targets that the Federal Reserve has set for inflation and the kind of overheating scenario, which is much more of a spiraling story. We don't see the latter. We think the probability of it is quite low relative to the upside risks that we've been describing so far and what you heard from Dom.
Dom also was talking about the connection between stimulus checks and people opening up brokerage accounts. Do you have an opinion on if that's how stimulus money should be spent, given that you're now looking to get $2 trillion passed and a lot of Republicans don't want that to happen?
Well, let me say the following, just to start that out, is that while we watch the stock market carefully, and of course, you know, with lots of people having retirement accounts in there and so on, it's important. I'm not going to downplay it. But remember, half of households own no stocks at all, including through pension or retirement accounts. So it is not a gauge by which President Biden assesses how people are doing, especially in a recovery where we still have folks on the bottom leg of the K trying to climb back. Now, we know that about a third of the stimulus checks are spent, about a third are used for paying down debt, and about a third have been saved. And that seems to me to be a fine calibration of that kind of use of resources. But while the stock market is, an indicator of how investors are doing, many of whom are at the very high end of the income and wealth scale, it doesn't tell us nearly enough about how broader America is faring.
Let's talk infrastructure. I mentioned it. It's a $2 trillion plan. Republicans say they will spend up to $800 billion. That is something. So what's next? Is there a way to split this thing? There's a lot in there.
Well, I think we have to talk about what this thing is. And yes, there's a lot in there because it is so important that we end decades of disinvestment in broadband, in grid, in water systems, modernizing our schools and our ports and our airports and our rail. So if Republicans want to talk about peeling off certain parts of that, they should bring a plan forward. And the president has said he's willing to look at that. In fact, he really has just outlined one very firm condition, which is that inaction is unacceptable. Now, if you look at the American Jobs Plan, we believe it's a package that addresses the very broad swath of disinvested America infrastructure, everything from clean energy to a care economy. But the president has said he's willing to listen to other ideas if they represent making those kinds of investments.
Willing to listen, that's a start. And one way to pay for this is to raise corporate taxes from 21 to 28%. Amazon outgoing CEO Jeff Bezos says he likes this plan. Well, sure, he likes this plan. When there's more money in the economy, people spend it at Amazon and Walmart. But companies like Amazon, it doesn't actually matter to them if the corporate tax rate goes from 21 to 28. They currently pay zero, like lots of other corporations. Isn't it more important to focus on closing those loopholes than looking at the overall rate when so few companies pay that number to begin with?
Yeah, that's a really great way to tee up the question because they're both important. If you raise the rate without broadening the base and closing some of the loopholes and starting to try to shut down some of those avenues of tax avoidance, then the higher rate doesn't mean very much. And in fact, if you look at the effective tax rate, meaning the share of their profits they pay in taxes, multinational corporations have been at about 8%. OK, so that's lower than many middle income households. And that has to do with many of the loopholes and avoidance techniques, particularly regarding the offshoring of investments and profits and jobs that currently exist in the tax code and were exacerbated by the Trump tax tax cuts. And the tax plan that we're putting forth closes those loopholes, ends the race to the bottom, and makes that 28% rate more binding.
We know people who've been out of work are getting the much-needed enhanced jobless benefits from now until September. But I want to share with you part of my conversation with a local florist for a nightly news story coming up. She is trying to hire some seasonal part-time workers, and here's what she's up against.
So when you're trying to hire people part-time, what response are you getting from them?
Basically, we'd love to come back to work, but we can't lose our benefits to do so.
But is the issue for them, they can't take the pay cut?
That's right, yeah. I can't afford to pay them what they need to live, so, and they would be sacrificing their benefits.
Do you think it's not correct that we assume people aren't coming back because it's health and safety? You think it's economic?
I think it is economic.
Is that a problem we can fix?
Well, first of all, I think we have to distinguish between anecdote and data. They're both important, by the way, and I'm not dismissing anecdotes. But from our perspective, we have to see it in the data. And thus far, it's not something we've seen. I mean, last month, we created, I should say the American economy created over 900,000 jobs. And you reported earlier that the unemployment claims have been coming down, fairly regularly, still at an elevated level, but coming down pretty reliably in recent weeks. So people are leaving unemployment. People are coming back into the job market and getting jobs at a pretty hefty clip. Now, last time we looked at this a few months ago, we couldn't find much of a correlation between enhanced UI benefits.
A few months ago, or even last month, the economy wasn't really open. So now you have all of these businesses starting to reopen as we get vaccinated and try to hire shift workers, low-wage workers, service workers, and they're saying they can't.
Yeah, well, so that's exactly why we need to continue to look at this. Thus far, what we're seeing is robust job creation, and we're not seeing a great deal of differences between places where enhanced benefits have more of an impact than places where they don't. It's also the case, though, that we have some hot spots where variants of the virus are rearing up. And so I do think people trying to remain safe is also in the picture. Sorting all of this out is important. And you're right, Stephanie. We can't just rely on analysis that's stale. We have to continue to watch these developments.
It is a dynamic situation. Jared, always good to see you. Thank you for joining us.
Hey, thanks for watching our YouTube channel. You should know that you can follow today's top stories and breaking news and catch up on your favorite MSNBC shows all in one place. Download the NBC News app today.